Hello, and welcome back to the channel. My name is Zach Collins, and this is Financial Education. For those of you that don't know me, what is my background? I was a financial advisor in my past, fully licensed, fully FISA compliant, specializing in super and non-super investments. I'm not licensed anymore, but I'd love to get my license back one day. I left the industry as I couldn't stand the owner of the business, and I've got no interest in sales. It's not all sales, but my passion is to work with people, not to sell various managed funds or insurance products. These days, I work in tax and compliance. Let's get into it. So today I want to show you guys the difference between the return you would get when investing in property versus investing in stocks or ETFs. Why is this important? It's not. It's just for entertainment purposes. However, it's also quite interesting as, you'll probably know, property is the biggest form of investing we do here in Australia. You'll find that every single wealthy person, they seem to always have an investment property. I'm going to let you in on a little secret here. I work with a lot of wealthy groups, and while the group might be involved in property in some way, let's say they're developers or they run a hotel business or stuff like that, these wealthy people, they tend not to personally have investment properties. No idea why. In the past, people have been able to increase their wealth exponentially by investing in property and using leverage and negative gearing strategies. It only works to a certain point. Granted, this is still a high wealth point. You're talking 10 to 15 mil, but from my experience, the real wealthy people, so you're talking those with a wealth exceeding 100 mil, they don't invest in residential property like the lower tier wealthy people do. Getting back on track. So if you do want to maximize your wealth, which one is better to invest in? Property or stocks? I'm going to go through a few different ways that you can quantify your investing. We'll look at the average performance over the last 15 years. We'll look at the cost of each investment, and we'll look at how leverage plays a role. When we combine all three of these different areas, we'll come up with an answer. Sounds good? Let's dive in. Let's start by having a look at the median property value today and the median property value 15 years ago. This will show us what the performance has been for property. Obviously, this won't be reflective of every market. Some will have performed better, others worse, but on a macro scale, this is what property performance has done. Now, I'm going to be using the Canberra market as it's the most stable. It's neither the top or the bottom, and it'll give us some data that's close to the national median. In 2009, the median house was around $500,000. Today, it's around $970,000. Let's say that's about 2 times in property price over 15 years. Investing in the ASX over that same period would have yielded a 3x return. I'll link below my sources for anyone interested in seeing more data. On a dollar for dollar value comparison, property underperforms the stock market. Don't get me wrong, 2xing your property value is a good return. If you think about it on a 30-year scale, which is how long most mortgages are, the property value would 4x from your initial property purchase by the time the mortgage is paid off. If you've been paying attention, you would have seen that the ASX graph also included a dividend return. The property value only included capital return. Why am I saying they're like for like when I'm excluding rental income from the calculation? So if you're looking, the capital return at the same time period they're basically identical for both the ASX 200 and for the median property. I actually found this to be super interesting. The difference then becomes the income return. And this is where we come to the second questions we had, which is the cost of the investment. When you buy an ETF that invests in the broad market, they charge you a small fee in the form of an MER, which stands for Management Expense Ratio. There are a range of different ETFs that passively follow the ASX 200. I've already done a video on them, so make sure to watch it if you want to dive in further, but the cost average is around 0.05%. So if you have a $500,000 invested and it charges you 0.05% per annum, that's a cost of $250 each year to manage that investment. How much does a property cost to hold? I mean, it really depends on the specific one, but I can tell you from experience, it's a lot more than 250 bucks. Property as a whole tends to have a low yield. So a high yielding property will get you, say, a 0.01% of the purchase price per week in rent. However, that is mainly apartments, which have lower capital returns. And houses, their rental return will be about half that. So you're thinking of about a gross yield of about 2.5% per year. Let's take our $500,000 property. So each year generates a yield of 2.5%. This means there's rental income of about $12,500 a year, but then you've got costs to rent it out. I'm personally spending 7% of the rent to my agent, so that brings the rent down to $11,625. In the ACT, there's land taxes. This will be about $2,000 to $4,000 depending on the property. Let's keep it on the lower side and bring our rent down to $10,000 net. There are other costs associated with owning properties too. You need insurances in case the property is vacant for a period. Let's say it's $500. You've got repairs and maintenance. If it's an apartment, that would be part of the strata cost. But if it's a house, that can be variable. But it's good to keep aside, normally around 2 to 3 grand a year. There will be stuff I haven't thought of, but let's say that's all $3,000 all in, which brings our net rental intake to about $7,000 a year, which is a net rental yield of 1.4%. You do need to bear in mind that in this calc so far, we haven't included the cost of a mortgage. That's because at this point in time, we're just looking at the difference between property and stocks on a one-to-one comparison. It doesn't make sense to compare stocks at cash value, but property with leverage. Okay, so we've gone through the returns that each has produced over the last 15 years. We've looked at the cost of the two. Now let's go through the big differentiator, which is leverage. When you buy a property, you buy it with only a small amount as a deposit. If you don't want to pay LMI, lender's mortgage insurance, you generally put down 20% of the property price, and then you'll borrow the rest. There are banks that will offer lower loan to value ratios with no LMI. I got both of my places at 85% LVR with no LMI, and there's also some government incentives for first home buyers at 5%, but all of these are generally own occupier only. And so for rule of thumb, in investment properties, you need to keep it at 80%. So what does 80% LVR mean? It means for every dollar that you put into the property, the bank will lend you $4. So essentially out of $5, $4 is debt and one is your own equity. When you get a mortgage, you have to pay that out over a 30-year period. You can have different loan terms, but 30 years is pretty standard. If you're comparing purchasing this $500,000 with 20% down, that's a $100,000 deposit and a $400,000 loan. With the equivalent in shares, it's not possible. The reason for this is when you borrow to buy shares, the banks consider this a lot riskier. So they won't give you as good leverage ratio on margin loans. Typically, it's best to stay under 50% LVR, which means for every dollar you invest, you have a dollar of loan, which is significantly less than with property. You're also penalized as the banks would give you a higher interest rate. If the banks are willing to give you 6% on a home loan today, you're looking at close to 9% for a margin loan. And you're also penalized on time. While mortgages can extend to 30, even 35 years, a margin loan typically won't go past 5 years, meaning the repayments will be significantly higher as you need to pay off the principal faster. These are the main reasons leverage is not that common when investing in equities. The banks won't lend you as much as they will give you a much worse interest rate and term conditions. Now, using the Money Smart mortgage calculator for a $400,000 mortgage at 6%, over 30 years, that is going to cost $2,400 a month or $28,800 a year. I showed earlier with the rental income and expenses that you net about 7 grand. This was before factoring in a mortgage. When you do that, it means that the investment losses is $21,800 a year. Now, some of this you can claim as a tax deduction, not all of it. That's how negative gearing works. So you pay the mortgage for 15 years. Your property is now doubled in value from $500,000 to $1 million, and you've been losing about 21 grand a year, or about $315,000 over those 15 years. You've also paid down the mortgage. Instead of owing $400,000, you now owe $250,000, and you've spent $432,000 in mortgage payments. Why do you still owe over half when you've done half the time, and you've paid back more than the amount you borrowed in the first place? Because interest is essentially front-loaded. The sooner you can get your principal down, the sooner the loan will be paid. You're being charged 6% interest on the full amount from day one, and in the first year, you're lucky to pay back more than a few grand. It takes a really, really long time to get that snowball rolling and to actually start properly paying down the principal loan. So where does that leave you? You have a property worth $1 million, Let's take away $250,000 for the remaining mortgage, so $750K in equity. You've also lost $315,000 for negative gearing, so your overall investment is really worth 435 grand. For the stocks, I've got a little spreadsheet that I made, and it shows the growth of the portfolio if you had only invested in the stock market. Let's take a look at it now. Okay, what have we got here? So this is the spreadsheet, and so obviously we were investing $100,000 to start with because that is what the principal amount was. Now I've got 8% here as the interest rate or the return rate. That is roughly what the ASX 200 has done over the past hundreds years. So 8% is a normal return. What we've got here is income and growth. Now this is done on a monthly basis because we're contributing money on a monthly basis. We are assuming instead of paying a mortgage, we'll be investing that money instead into the stock market. So we've got income and growth. So we're getting 8% on a monthly basis. So not 8% each. So 8% per year overall divided by 12, which will give you a monthly return. Your mortgage payment, and this is what each value will be worth at the end of the month. Okay, so we're just going to scroll down here, and you can see 60 months. So this is 5 years. What that's worth. What have we got? 120. So 120. This is how much you've got over the 10 years. And then we're going to get to 180, which is here. And you can see it's worth $1.2 million at the end of the period. So as you can see, the final balance is just under $1.2 million. You've invested $100,000 to start, and with the monthly mortgage repayments replacement, which is about $2,400 a month, that's $432,000 a year. So it means the total amount that you personally invested is $532,000, which means you've essentially made a profit of 630 grand, which is about the same amount as buying the property with full cash down. I know this video might sound like I'm advocating for one style of investing over another. I'm really not. This is just to show you how different asset classes perform and what you need to be looking out for. Personally, I have made more money in property than I have investing in the stock market. My parents are the same. They've invested a lot of money in property and they've made bank due to leverage returns. It all comes down to your personal preference and how you want to grow your wealth. As I said at the start, all the ultra wealthy people that I have seen, they don't buy residential property. There has to be a reason they're ultra rich and we're not. Hopefully I've been able to give you a better understanding of how different asset classes perform and the different costs associated with each of them. If you've got any more questions, please feel free to drop a comment below and I'll answer if I can. Thank you guys so much for watching, and I'll see you on the next one.